In the past 15 years, the credit risk professionals of Ardmore Banking Advisors have performed over 70 due diligences, representing both potential buyers and sellers in the M&A process. Our experience with these engagements has provided us with a wealth of information about best practices, significant errors to avoid, and the most effective key performance indicators to evaluate throughout the process to ensure a smooth transaction and transition. We are proven experts in assisting banks in the M&A process, and it's been our privilege to partner with Bank Director and RMA in recent years to present 2 webinars discussing the importance of due diligence during a merger or acquisition. We assembled panels of experienced bank and accounting firm executives to share their opinions and suggestions on the M&A process. And what follows are some highlights, with information that is relevant to all banks, regardless of geographic location, asset size, or current market conditions. Please enjoy.
Can you talk about the importance of performing a thorough loan portfolio analysis, digging a little deeper than in the due diligence process? Bankers are often relying on models and other things. How important is a thorough due diligence, drilling down to individual credit review in the process?
Well, I think it's critical when determining the pricing and digging down, and it has to be done. You have to do more than model. Modeling is fine when you're looking at homogeneous loan pools, really smaller credits. However, there's really no substitute for looking or doing a deep dive into the larger exposures and large concentrations, especially in today's environment, certainly in the CRE environment, and looking at the target's CRE portfolios. Additionally, the deeper dive will give you it should give you a fair amount of insight into the target bank's credit culture and their underwriting standards. We're going through a merger of equals right now, and we spend a lot of time analyzing the target's loan portfolio.
We went through a long period of good times, right? And, in good times, every loan looks good, right? So, as things pull back, some of those warts start to show. And, you think about, banks that have had significant rapid growth, those are the things that I would focus on the diligence phase, right? Because if it's not the organic, growth rate that was in the past, at that point, we saw how competitive our markets are. In New Jersey, our market's extremely competitive. So you can see that, everyone's fighting for business. So, there was some loosening of standards along the way. And I'll give you a quick story. When I worked for a public bank, this was years ago, we went through an investor conference, and it was basically one of those speed dating things. And you meet with investors, a ton of investors throughout the day. And, the last investor approached us, and we talked about how we weren't doing the, caving into the competitors and doing things irrationally on loans. And that, XYZ, these banks are all ultra competitive, and they're stealing business, and we're not, caving into those standards. And the investor came back to me and goes, every single executive team over the last 2 days told me the exact same thing. So who's lying? So, so I think it's critical, when, especially now in the diligence phase, that you get your arms around what you're actually getting.
I mean, what's the old saying? Most bad loans are made during good times. I mean, that unfortunately turns out to be true. And I think that whether you're a buyer or a seller, you really have to know what you have, right? You really have to have a third party, an independent entity come in and take a look and tell you actually what's there. You need to understand what you're selling, and you need to understand what you're buying. And I think that's always a critical factor.
How critical to a buyer is it to have a third party perform or assist in the due diligence process from an industry expertise standpoint, from another set of eyes? What are the considerations or things that you're looking for, or you would look for in that process to assist you?
We think having a third party in is critical for us, especially when performing and establishing the credit marks. Um, as we go through our acquisition, it was important for us to have an independent point of view come in. It was important on a couple levels. It was important to our investment bankers, and with respect to their fairness opinion. So that was one aspect of it. A third party also provided us with some additional insight into the target's credit culture and credit administration, to try and take away maybe any preconceived notions we might have had or did not have. It was good to have an independent party look at it, at all of that for us. We can't stress how important it is for us anyway to have an independent third party come in and help us establish the roadmap in terms of where to look and what to look for.
The principal reason is gaining expertise and experience that you probably don't have on your staff or across your whole staff, and you know limited resources, right? And you're trying to do this over a weekend or a short period of time. So having that third party to assist will help you get it done more efficiently, right? You don't want to bring in clerks into the process because the whole process is highly confidential as well. And the last thing, I think, Jeff touched on it. You're buying a bank for different attributes and maybe different skill sets or different product lines. Sometimes your existing staff may not be familiar with those things or may have a tainted view towards them. If you're trying to get into, I'll give you an example, as a savings bank trying to be more commercial, so there may be some more, view of being conservative versus getting an independent view of it from the outside. So I think it's very critical in the process, and also incorporating your existing team, in the process, because ultimately they'll be managing the portfolio and those relationships.
I totally agree. Certainly, we wouldn't have the assets to be able to do that efficiently. And I think, when you're talking about credit marks, in a relatively, if you're acquiring a bank $500 million, maybe you could absorb a $5 million credit mark. But are you going to absorb a 10 or a 12 or a 15? And if you do, what happens? You dilute the price. You could reduce the price 20-30% depending on what that credit mark is, and all of a sudden the deal doesn't work. You have to know what you're doing. You have to see it.
Regulatory headwinds, are those impacting right now timing and I guess strategy to an extent of these deals closing? Are you seeing any of that in the marketplace?
Just the opposite, Todd. I mean, really, the regulatory headwinds these days are few and far between in M&A deal making. Deals are getting from announcement to closing are averaging around 120 days. I saw so really an expedited process relative to the environment that we were uh, coming out of under the prior administration. Is I mentioned the executive order that was a sort of a hard look at uh, M&A across all sectors, but banking in particular, really created a lot of slowdown in merger acquisition review. Deals were getting extended. We saw deals get out there about a year, some get out there 2 years, and that's just no way to try and pull off an M&A transaction. You've got capital at risk, you've got people's careers and their livelihoods and all that kind of in the wind. And we've seen in today's environment a total 180 from that. So deals are getting greenlit, and the other aspect of that is when you did a deal prior to the current year, in the last say few years during the last prior administration, that was your deal. You were going to do one, and you were going to kind of integrate. You were going to prove that you were successful in integration, get sort of the regulatory green light before you could go out and seek another transaction. Now we're seeing deals get announced right on the heels of deals closing. We're not seeing necessarily an encouragement, but really an acceptance and a path forward for getting deals efficiently reviewed and having banks moving on from start to finish.
What are the most important metrics, key performance indicators, and such buyers should be analyzing during the process?
Yeah, I think, Todd, that depends a little bit on why you're doing the merger or the acquisition, right? I think if it's an in-market consolidation of a competitor, that might be one set of things to think about. If it's market expansion, it could be another. If it's a true strategic merger of equals, there may be some other considerations. But in a straightforward acquisition, for us, I think you have to set some thresholds on what a couple of these KPIs are. You need to talk with your board and understand what their tolerance is for both dilution, return expectations for the legacy shareholders of your bank that are going to be allowing you through their vote to take the risk to make an acquisition. And then what are your shareholders going to say to you? What do you think about? And the best way to understand that is just talk to them. We frequently talk with our institutional investors, and they quiz us frequently, almost every conversation about our M&A appetite. And we turn the table on them a little bit and say, okay, what is fair to you? What do you think is a fair EPS accretion amount, first year in, or a dilution or an earn back? How long does it take you to earn back any tangible book value dilution? And so for us, we've set some minimum thresholds on EPS accretion for each of the three different types of transactions. We have set an earn back expectation. And most, Chad, you might chime in on this a little bit. There's most investors like to see that at 3 years or less on an earn back. There are reasons to go beyond that, and you just have to be prepared to explain, if you're going to pay something more than that, why you did it and why you believe that's the right thing for the shareholders. So those are the few that I would look at early on, and I caution everybody to be careful about some of the modeling expectations that you do use, because they drive these metrics and can move them pretty dramatically. Big one for us is we focus a lot on cost saves. What is a realistic cost save? And it's not just the cost you're going to take out of the acquired organization. There may be some cost saves in your own organization that you can affect, but there's also, depending on where you are in the asset size threshold, there are some expenses that you're going to incur as part of growing that you really have to net that out of the expected cost saves of a transaction, because you're going to have to make some investments. That's hard for a seller to understand sometimes, but if you're looking at it for the 24 and 36 month return, what is the expected return for this deal in 2 or 3 years as opposed to day one premium? I think those are some of the considerations I would have people think about. At least that's our view of it.
So we're very similar. So I'll go at it from a credit perspective. So from a credit perspective, the metrics that we focus on are the ones that truly reflect the underlying health and resilience of the portfolio, not just the headline numbers. We start with the basic, debt service coverage ratios, loan to values, whatever, risk rating distributions. Those give us an initial read on the credit quality and underwriting discipline. We think that's really important. But what's even more important is the trend behind those numbers. Are coverage ratios holding steady as rates rise? Have loan to values crept up with market appreciation? Are we seeing migration in risk ratings that signal softening performance? That movement over time tells us a much clearer story than a static snapshot ever could. We also look closely at portfolio concentrations by industry, collateral type, geography, because that's where exposure can quietly accumulate. In today's environment, with certain sectors under more pressure, understanding where those concentrations sit is really critical. And then finally, we try to analyze credit migration, how that portfolio has shifted among past special mention and classified categories. A portfolio that's stable through different cycles says a lot about an institution's credit culture and how proactively they've managed emerging risk.